Hello friends, Mike Engel with Bonanza Realty with your monthly commercial real estate report for Vancouver and the Lower Mainland. The numbers tell a sobering story about the state of commercial real estate in the Lower Mainland, but beneath the surface, they also reveal a market that is not collapsed, rather one that is recalibrating under pressure. 2025 will be remembered as the slowest year for commercial real estate transactions. 2009. It is a headline that immediately evokes the shadow of the global financial crisis, yet the reality today is far more. While overall activity declined, certain sectors demonstrated resilience and, in some cases, unexpected strength. According to the Greater Vancouver Realtors, a total of 1,335 commercial real estate transactions were recorded across the region in 2025. That represents an 8.3% decline from the 1,456 transactions seen in 2024. At first glance, that drop suggests a weakening market. However, when placed against a backdrop of global instability, persistent inflation concerns, and elevated borrowing costs, the decline appears relatively modest. More striking than the decline in transaction count is the contraction in total dollar volume. Commercial real estate transactions in the Lower Mainland totaled $7.466 billion in 2025, a sharp 23.2% decrease from the $9.723 billion recorded the previous year. This gap indicates that while deals are still occurring, they are either smaller in scale, more cautiously priced, or both. Economic headwinds have played a decisive role. Throughout 2025, investors navigated an environment shaped by higher interest rates, geopolitical tension, and ongoing uncertainty in global markets. These factors have collectively made financing more expensive and investment decisions more complex. Yet even in this climate, the market has not moved in unison. Instead, it has fragmented into divergent asset class performances, some sectors contracting sharply, while others gain momentum. The most significant decline was seen in the land sector. In 2025, there were just 212 commercial land sales, marking a dramatic 48.5% drop from the 412 sales recorded in 2024. The decline in dollar volume was even steeper, falling 59.5% to $1.778 billion. This pullback reflects a deeper issue. Developers sense with an oversupply of newly completed but unsold units reaching historic highs, developers have grown increasingly cautious. The economics of new construction, particularly in a high-cost city like Vancouver, have become more difficult. Rising construction costs, elevated financing rates, and uncertain future demand have all contributed to a reluctance to acquire new land. In many ways, land transactions act as a forward-looking indicator for the broader market. The sharp contraction suggests that developers are bracing for continued challenges, not just in the immediate term, but over the coming years. In contrast, the office sector delivered one of the most surprising turnarounds of the year. Office transactions surged to 367 in 2025, 58.2% increase from the 232 recorded in 2024. Even more notable was the jump in dollar volume, climbed 128.8% to $2.037 billion. This surge was driven in large part by a landmark transaction, $1.2 billion sale of the Post building at 658 Homer Street in downtown Vancouver. Deals of this magnitude can significantly influence annual totals, but even beyond this transaction, the data suggests renewed interest in office assets. This resurgence comes despite ongoing debates about the future of office space in a post-pandemic world. While remote and hybrid work models remain prevalent, investors appear to be identifying opportunities in high-quality, well-located office property. In particular, premium assets with strong tenant profiles continue to attract capital. Retail and other commercial assets also posted gains in 2025. Transaction volumes rose 10.7% year over year, reaching 352 sales. Dollar volume increased by 20.4% to $1.601 billion. This growth signals a continued recovery in the retail sector, which has undergone significant transformation in recent years. The shift toward experiential retail, combined with the stabilization of consumer spending, has helped restore confidence among investors. Neighborhood retail centers, in particular, have shown resilience, benefiting from steady local demand and essential service tenants. Industrial real estate, long considered one of the strongest performing sectors in recent years, experienced a pullback. Transactions declined 15.7% to 343, while dollar volume fell 29% to $1.300 billion. Despite these declines, industrial assets remain fundamentally strong. Demand for logistics, warehousing, and distribution space continues to be driven by e-commerce and supply chain evolution. However, the rapid price appreciation seen in previous years has begun to stabilize, and higher borrowing costs have tempered investor activity. The multifamily sector also saw a notable contraction, with just 61 transactions in 2025. Activity fell 29.9% compared to 2024. Dollar volume dropped 41.7% to $751 million. Even in a scenario where global tensions, borrowing costs are unlikely to return to the historically low levels seen before the pandemic. This new reality will continue to shape investor behavior, forcing a more disciplined approach to underwriting and deal. Looking ahead to 2026, the outlook for commercial real estate in the Lower Mainland remains cautiously restrained. The conditions that define 2025, elevated interest rates, economic uncertainty, shifting market dynamics, are expected to persist. Yet, within this environment, opportunities will continue to emerge. Investors with access to capital and a long-term perspective may find value in sectors that have experienced price-correct, high-quality office assets, resilient retail properties, and strategically located industrial facilities are likely to remain attractive. At the same time, the slowdown in land transactions could eventually set the stage for future supply constraints. If developers remain on the sidelines for an extended period, the pipeline of new projects may shrink, potentially tightening market conditions in the years ahead. In many respects, the commercial real estate market is undergoing a period of transition. The rapid growth and aggressive expansion of previous years have given way to a more measured, cautious approach. This is not a market in decline. It is a market adjusting to a new set of economic reality. For investors, developers, and industry professionals, the message is clear. Adaptability will be key. Those who can navigate the complexities of higher borrowing costs, evolving demand patterns, global uncertainty will be best positioned. As 2025 comes to a close, the data offers both a warning and a reassurance. The slowdown is real, and the challenges are significant, but the resilience shown in key sectors and the signs of stabilization in the latter part of the year suggest that the market is far from stagnant. Instead, it is recalibrating, preparing for its next phase in an increasingly complex and unpredictable world. If you are in the market, whether buying or selling, remember to give me a call so I can show you what my team can do for you.